21 record highs since January and up more than 15% year to date, the S&P 500 is off to its best start to the year since 2019 and the best start to an election year ever, driven by mega cap tech stocks and artificial intelligence tailwinds. After posting a 10+% return in the first quarter, the market cooled off a bit in Q2, returning just over 4%. Only 5 of the 11 S&P 500 sectors were in positive territory, with the big winners being the tech-related sectors of information technology and communication services. The notable change from the first quarter is that diversification was not rewarded in Q2. In fact, large cap growth is the only area that performed well. In addition to mid and small sized companies delivering negative return across the style box, international stocks were also negative. Year to date, the famed Magnificent Seven has accounted for 2/3 of the S&P 500 return. Volatility has been rather muted this year. One way I like to measure this is daily returns of the S&P 500 that are greater than 1%, positive or negative. As you can see from this chart, through June 30th, the index has experienced 21 such days. And on a positive note, 2/3 of them were positive returns. Compared to past calendar years, the market is on pace to have a muted year of volatility. I suspect this might change given that 2024 is an election year. Research suggests that in election years, returns become muted and volatility tends to increase in the months leading up to Election Day. That said, historical data also suggests that making investment decisions based upon political beliefs is not a recipe for long-term success. I recorded a video on this topic in April. See the link in the description to view it. Fixed income had an eventful 3 months, even though the quarterly return might not indicate that. Performance was bifurcated throughout the quarter as most credit-related sectors were positive on the strength in risk assets, while fluctuations in longer-term interest rates weighed on rate-sensitive assets. The 10-year Treasury covered a 50 basis points peak to trough range in Q2 before settling at 4.4% at the end of June, up 20 basis points for the quarter. In April, the Bloomberg U.S. Aggregate Bond Index returned negative 2.5%, declining for the 9th month over the past year and experiencing the largest loss since September. The index fell as Treasury yields increased along the curve amid resilient economic data, warmer inflation, and as markets reprice expectations for rate cuts in 2024. The index rebounded in May and June, returning 1.7% and 1% respectively. May was the best monthly return in 5 months. Fixed income rallied as Treasury yields fell along the curve. Inflation readings pointed to a resumption of the disinflation trend after a worrisome start earlier in the year. May's core CPI index increased at its slowest pace month over month since August of 2021, while the Fed's preferred measure of inflation, the core PCE inflation, fell 2.6% year over year, its lowest reading since March of 2021, which was welcome news for the Fed. When all was said and done, the Bloomberg U.S. Aggregate Bond Index returned 0.07% for the second quarter. Thank you for your trust in us. Contact me if you have any questions.